Hello, Professor. I will be talking about some financial health and the recent financial performance of the company. Also, about some weaknesses and strengths. Regarding the question one, I can say that there is no an ideal approach to decide a company's financial health, but not to mention supportability. There is a need of a lot of effort to go through the company and take like a very good study of what is going on. So we went over the ratio analysis of historical financial statement, which is the fiscal year in the exhibit 25.3. So one of the first things that I checked was liquidity, which is a critical factor in evaluating a company's primary financial health, because checking on the quick rate from 2020 through 2015, the company had a quick ratio no up to 0.42. The problem with this is that a quick ratio lower than 1 is a dangerous signal, because this is an indication that current liabilities exceeds current assets. The second step to check on is leverage. So leverage figure a company's long-term debt corresponding to its assets or equity. So, as we know, debt of equity ratios generally change depending on the industry. So, checking on the debt to equity ratio in this company, in 2012 was around 1.13. In 2013 was 1.12. The next year was 1.76. And in the year 2015, it was at 2.02. So I can say that the company were doing pretty well from 2012 until 2014, with a debt of equity ratio lower than 2, which is great. But in 2015, it went a little bit over 2. But it is still in the in the standard line. So after that, we investigate the working edge to see the proficiency of the organization. So it shows organization's first operational overall revenue and how well the organization's administration control costs. So I took the working profit of 2015 and the income from that year. So we take operating earnings and I divided that number with the revenues, and I got the number 15.7%, which is reflected in the financial statement. So I can say that the working edge of the organization from the years 2012 through 2013 was at 18.6%, while the number dropped to 15.6% in 2014 and had expanded a piece to 15.7% in 2015, which indicates that the organization evaluating system and working effectiveness was slightly dropped. So, however, in general, the edge was okay. So, regarding the return on sales, we estimated the money related gainfulness proportion that shows how much the benefit is making. So, it was typical 10.4% and 10.3%, somewhere in the range of 2012 and 2013. So at that point was good, and then it dropped radically to 6.8% in 2014, and in 2015 was in 6.4%. So this indicates to a negative sign to the administration. So the return on assets indicate that complete resources on how much net income could create. Could create in the year was 2.12. So the organization could produce exceptionally low, and then, when more regrettable, because it declines to 3.7% in the year 2015, which was not a decent sign. So after that, the organization shows the business development rate and resources development rate from the year from 2012 to 2015. So for deals development rate, the organization had a development in deals at 15% in 2012, and then it dropped to 14.5% in the year 2015. So, on the other hand, the asset growth rate has stayed by step by step expanded, having a radically high low. So, the benefits development rate in 2012 was at 8%, and it hit 28.5% in 2014. So, the explanation is because the organization had an enormous increment in inventories. Then it dropped to a typical range at 14.9 in 2015. So the following year, because the organization had an expansion in account receivables just as inventories. So that's what we went through. And now, so I saw some weaknesses in the company. One of those is that it's getting a ton of cash to work the business. So likewise, it is expanding their obligation leads to a higher default chance. And about strengths, for example, the company has a generally excellent adaptability to adjust the drift current business, and it has a unique and high quality and a very good development rate in terms of offers. That's it. Thank you.
Hello everyone, so today I'll be talking about the pro forma financial statements that I prepared for Star Rivers Electronics. And as the CEO Adel & Co. expected, we used the sales growth rate as 4% for 2016 and 2017. But however, the historical sales growth ranged from 11 to 15%. We still decided to follow the CEO's orders and use the 4% sales growth rate for the 2 years. And then as for the income statement, the sales, basically everything in the sales except depreciation and interest expense, which both of them remained fixed for the 2 years. Everything else was added by the 4%. And then also for the dividends, we used the 2 million, and the numbers in this chart are in thousands, so that means the 2000 means 2 million. So we decided to keep the dividends as 2 million. And then the corporate tax rate was 24.5%. And then our net income are shown below over here. For 2016, it was 13.2 million, and for 2017, it was 14.1 million. And we all know the formula for finding retained earnings, which is subtracting dividends from the net income, and then we found the retained earnings for the 2 projected years as shown below down here. And as for the depreciation, we divided the 54, I think it was 54.6 million, and it was supposed to be spread out for the 2 years, for 2016 and 2017. So we divided to 27.3 million by 7 years. 7 years is the useful life of the investment, and we ended up with 3.9 million for each year. So as it's shown here, the depreciation for the 2 years are 3.9 and 3.9 for the 2 years. And this is the first part of the pro forma balance sheet. And I basically multiplied everything by 4% except the long-term debt and then the short-term borrowings from the bank. And as for the assets, everything was multiplied by 4%, and then the accumulated depreciation was found by subtracting the new depreciation from the old one from the previous years, and then we found negative depreciation for the 2 years as shown here, and then this was our estimated projected total assets for the 2 years. And this part shows the liability and the equity part of the balance sheet. And then as I told you, I didn't change anything with the short-term borrowings and then with the long-term debt. And as for shareholders' equity, I used the following formula. I used this formula over here, beginning equity plus net income, and then I divided the dividends, and I ended up with the end equity, and then from that I added the projected retained earnings, and that's how I came up with the new equity. And then I basically added all those here, and then this total liabilities and total stockholders' equity is supposed to equal the total assets. And then the difference between the two numbers are my EFN, external financing needed. Okay, and the external financing needed for 2016 was 808,000, and then for 2017 it was like 10 million approximately. Okay, and this part here basically wraps up everything that I just explained. All the depreciation that I used, and then what numbers remained fixed, and then how I found the equity. Okay, and to find the EFN, I also explained that I used the basic accounting equation, assets equals liabilities plus equity, and then the EFN tells us how much additional money is needed to be borrowed from the bank or from external source for the new investment to be implemented. Okay, and then I also calculated the sustainable growth rate and then the internal growth rate. So these two numbers basically tells us how much the project how much the company can make without any external financing. And then these were the rates that I found, and this is also how I found the ROE and ROA. And I used the blowback ratio and then the dividend payout ratio to find the sustainable growth rate and then the internal growth rate. Okay, and I also want to talk about the key assumptions of forecasting. Okay, forecasting is very important in financing since it tells us, since it helps us to predict the future and it prepares us for any future expectations, and then it helps us to estimate the sales forecast, income statement, and balance sheet forecast. And then it tells us whether an investment plan is worth implementing. And it also helps us with hypothetical situations. And I've also added the ROE and ROA over here for the projected periods.
Hi, Professor. This week, my first question is, what are the key driver assumptions of the firm's future financial performance? And my answer is the key driver assumptions of the firm's future financial performance is that the company will continue to improve and grow the same way it does between 2012 and 2015, given that the market is not valued. And my next question is number 4. What is Star River's weighted average cost of capital? What methods did you use to estimate WACC? What are the key assumptions that especially influence WACC? And my answer is the WACC of Star River Company is 11.09%. To calculate WACC, first we have to multiply the cost of equity with weight of equity. Then add this number to the product of cost of debt and one tax rate. Lastly, multiply this number with the weight of debt. In this case, the key assumption that influence WACC is the prime lending rate in Singapore. WACC can be affected by many factors such as using whether or not using the market value or the book value. Also, choosing the rate of return is very essential because the risk-free rate is one of the crucial components of calculating WACC. All the components of the WACC computation determines the WACC. The key assumptions are cost of equity and the cost of debt. And next one is my calculation of the WACC.